Okay, let me open up break. All right, so let me see. I'm gonna open up K and L.
Joe, Zoom also has AI meeting summary.
Oh, do they?
Yeah, there
Since
is
when?
a there is a button called summary below. It's
Oh,
near share screen.
okay, I think we got Miki coming in now. AI companion. Oh wow. All right, well, we'll see how this works. All right, so the good news is that there weren't that many issues that I really came across. Share screen. And most of them were things that we never even really discussed. A couple of them we did. So let me just go through how this should work. Let me show you how I review a return. So the first thing that has to happen is the net profit has to match the P&L. Okay, with adjustments. So in other words, if we have something like meals and only 50% of it is deductible, what I do is you take, let's say it's $1,000 in meals, 500, the profit is going to be $500 more than the P&L. Okay. Uh, Another thing, and I actually didn't list this, contributions are not a deduction. Let me show you where contributions go. On the K1, so contributions are under other deductions. It would go here. That's where it shows up on the K1. Now, where you put it is, let me see, it would be shareholders pro rata share items. Okay, so these are items that don't go on the income and expenses. Okay, so if there's interest income, it goes here. So that's going to be another adjustment on your P&L. Not many of our clients have interest income, but just in case they do, that's where it goes. Uh, Here is deductions. So this is where contributions would go. Okay, so it doesn't, So it doesn't belong here. Okay, got it?
Joe, can I ask question?
No,
Yeah, I noticed under the deductions, under the contribution, cash contribution, and there's an open parenthesis, 60%. Does it mean only 60% will be deducted?
yes. And only if they itemize. Only if they itemize. Because what's gonna happen is when you do their 1040 return, that's gonna go, so you'll see on the 10, and we'll open it up. When you enter the info from the K1 on the 1040, it's gonna give you each line. Okay? And you're gonna go up to, you know, box 12 with other deductions, and it's gonna tell you, you know, where contributions go. But the truth is, if you look at our returns, very, I don't even, a very low percentage of clients get to itemize. The only way they're gonna itemize is if they have a big mortgage. Because their state income taxes, their income taxes are limited to only 10,000. Then the only other things that you have besides interest, for the most part, are contributions. So we could go through all our clients, and I don't remember one that itemized. Even medical, you know, they'd have to be really, really sick. Okay, and have not that much income, because once you subtract that 7.5%, they're not gonna get medical. And that was by design. That was by design, because I think the IRS realized that a lot of people cheat on the itemized deductions. They fudge numbers, and there's no way for the IRS to police it. So let me see. Okay, so let's go through the major issues.
Joe, I have question. Because I just found out now that the interest income should be put in the Schedule K. Because normally, if I saw P&L in Wave App, sometimes we have clients that they have sales and then interest income. But when we input that in Drake, we only input the total gross income. We don't separate the interest.
I know it's not right.
So what's the effect, Joe, if we didn't put it in the Schedule K interest income? I just want to know.
It's really a non-issue. It's unless they're subject to that investment income, that there's like another tax for investment income. But our clients, you know, what do they get? $10 in interest?
Yeah, very minimal. So,
Yeah,
but
it's not like but if we want to do this right, and we do, that's the way you do it. Okay. So the biggest issue that I came across, and it wasn't worth, you know, going back and putting it back to Luz and saying, you got to fix this. It's the questions. It's always the questions. So let's go through, because I believe that the questions, see, right now the IRS is in total chaos. They're not auditing people. They're just not in a position to do a lot of audits. But once they get their act together, because this is all going to be driven by AI. It's all, forget about, So before, audits were all conducted by people, and people cost a lot of money. So it might take a couple of years, or I might be wrong because AI is here. It's already here. And so these are the so first of all the questions have to be answered. Okay.
Joe, do we have final agreement about there's a question about, are you issuing 1099? Me and Kathy are confused what to answer because, is it, last time you said we should answer yes or?
Well, I think we're going to cover that. So most of these questions, and we actually go through this in the courses, most of these questions are always no, because they just don't apply to small businesses. Okay, so the first question that's important is this one about the total receipts. The total receipts and assets, if they're both less than 250, we hit no, and then we don't have to do the balance sheet. We don't want to do the balance sheet. Okay, because we don't want to give the IRS more information than what they're even asking for. So if we don't have to do the balance sheet, I don't want to do the balance sheet. That doesn't mean that our balance sheet shouldn't be accurate. Okay, what accountants have been doing for the last, ever since QuickBooks came on the scene, that's when accountants forgot how to do accounting. So they would just take whatever garbage their client would give them from QuickBooks, and the balance sheet just never balanced. Clients cannot do bookkeeping. So they would just leave it out, and they would take shortcuts, and they were doing their clients no favors. Okay, we're going to do a workshop on Friday about how to become a CFO. I want all of you to become CFOs. Okay, I want you to look at their financials like they actually matter. Okay, and we'll go through that again, the way that I review a P&L and a balance sheet. Okay, if you don't know already, there's red flags. Like if there's a negative balance in a credit card account, well, that means that we probably didn't record some expenses. Or if there's auto loan, but we don't have an auto on the books. Okay, it's easy for me because I'm doing this for 40 years. But there's just, as you go through the balance sheet, there's got to be backup for just about every number on there. Okay, so this is the first thing. I don't think anybody really got this wrong, but it's still important. So with K&L, their revenue is like 800,000. So they didn't qualify for that. So here's the 1099 issue. I think what we're going to do, Luz, just to make it simple, is, oh no, I mean, we're going to have to do this right. And we might have to coordinate. Catherine, are you still going to be doing the 1099s? Who's going to be doing them?
Actually, Joe, I recommended that the accountant will do the 1099 of their clients.
Oh, that's even better. That's even better, because then when they do the tax return, they're going to know the answer. So this was something that a couple of times I came across. So in the course, I specifically say you can't say yes to 14A and then say no to 14B. See, that's the kind of thing that the AI is going to pick up. And it's going to say, oh, you were supposed to file these, but you didn't. So if it's yes here, then 14B has to be yes. Okay. Again, that only happened a couple of times. But so, and this is what you have to do whenever you do a return. And again, I talk about this in the classes. You gotta take a step back. Maybe you finish the return, and maybe the next day you go back and you review your own work. And then you ask yourself, does this actually make sense? Does this return make sense? Did I answer all the questions? Because it's easy to miss a checkbox. It's easy to miss one. But if we're going to scale this, we need to have the right procedures. Okay. Now, the biggest issue that I came across was the AAA account. Now, I picked this one because they have a problem. They have a serious problem. And the problem is they made $100,000. The profit, well, let's say it was 100. It says 84, but let's just say it was 100. And then they took out loans. They took out loans, and then they took the money from the loans. So they took out more than what they made. That's a problem, because the way the IRS would look at that is, well, technically, they have a capital gain because they took out more than what their basis is. The only way you have basis is if you either put the money, either you put the money in or you have a profit. You can't take out a loan and then take that out as a distribution. They would have been better off taking it out as personal loans and not putting it through the business. Then it doesn't show up on the corporation. So what I had to do was this. So
Josie.
the accumulated, and this was the biggest issue that I had every time I reviewed a return. I don't ever want this to be negative.
Joe, excuse, can you accept Prelos?
Yeah. So
Thank
this
you.
should never, ever be negative. And the
Yes.
way that you fix it is okay, so here I lied. I said, because I'm not going to show minus 136,000. I'm not going to show that because actually this AAA account should match the retained earnings. And you could see it doesn't.
Yeah.
Now I only did that because I know that we can get away with it this year.
Joe, I have question. Even though you fix the Schedule M and then you made sure that it's not negative amount, as looking at this balance sheet with negative retained earnings and there's a liability, it's still questionable. It's still questionable, right?
Oh, yeah.
So it doesn't also helps if, or it's just to avoid being it's still a
I
red flag,
know,
so you fix the
I-
schedule.
I know that the chances of the IRS of this triggering an audit this year is slim to none.
Hmm.
The IRS is in no position, but this is not the way that I want to do these returns. Okay, don't do what I did here. I have a meeting with them tomorrow to explain what they did. Okay.
Yeah.
Because now what they have is they have a lot of money that they owe. And I'm going to ask them, what the heck did you do with all that money? If you made that, what are your personal expenses? Why did you need to take out, so much money? Unless they tell me, oh, they put it into marketing or something. But you can't run a business like that because now they got to pay interest. All right. So, it's not enough just to have a lot of sales. You can't just have a lot of sales. You gotta, and that's why we need to be CFOs. Because now we could tell them, listen, I'm looking at your balance sheet and you're all upside down. They're headed towards bankruptcy if they keep running their business like this. Look at how much money they had $13,000 in the bank, and they owe over 150.
Joe, is there a tax advantage of declaring your loan in your business and then just withdrawing it? Is there a tax advantage?
No, it's a disadvantage. So there's what they call good debt and bad debt. Okay. So let's say, we have a client, he bought a dump truck. Okay. He doesn't have a business without the truck. So the truck was, and I don't know what it was, let's say 300,000. They're not cheap. So he put $50,000 down at his own money and he borrowed the rest. That's good debt. It's needed. Okay. It would be crazy even if he had the cash, you don't spend $300,000 of your own money. But he's got an asset. Those things don't go down in value because they last forever. Those trucks will last 30 or 40 years. In fact, I had clients that had big trucks and they would pay them off and then refinance them. Okay, that's good debt. But they have no assets. All they have is cash in the bank. So that's not good. And there's no tax advantage to just taking out a loan. So my question to Kevin tomorrow is going to be, what exactly did you do with that money? Don't tell me you used it to, do improvements on your house. Okay. But that's more of it's a tax issue. It's also, how are they running? Go ahead, Agnes.
How about you if the cash in bank is negative, the overall for the year end?
Then we might want to drop them as a client.
Come again, so
How are they going to pay us? How are they going to pay us? So if it's
that
negative,
is for regulator, Joe. They have
no,
negative.
regulator. So let me explain what happened with regulator, Agnes. They never even had bookkeeping. Nobody ever reconciled their bank accounts. All of those numbers that they gave us were wrong. Their accounts receivable and their accounts payable have stuff on there that was like 10 years old. I'm like, if somebody hasn't paid you in 10 years, you're not getting paid. Now, I might be exaggerating, but the truth is their books weren't worth anything. What I did was I took the tax return, the ending balance, and none of those numbers were right because their accountant did what I said that accountants do. They didn't do any accounting. They just took the garbage that regulator gave them and plopped it in. They made 2 journal entries with no backup. You know, I saw what you did. That's what should have been done. That's what they should have been doing. But we're in no position to do that kind of detail work. And the people that are running it now, this guy Serge, he's not a business owner. He worked in the field. He never worked in the, he got scammed. He got scammed by the previous owner. The guy fleeced the company. He gave it to Serge. He said, here, take the company, because he had a criminal problem. Okay, he was on, yeah, that's a whole nother story. So in the United States, you can have a union company or a regular company. You're not allowed to have both. It's illegal, even though they all do it. Well, this guy got caught. He got caught, so he was under investigation. So he had to get rid of one of the companies, and he got rid of this one. And what he did, because I could see it, he just took all the cash out of the business. They didn't pay their bills, and he just kept taking the cash out, and he left Serge $2 million in debt. On top of that, Serge had a bookkeeper. He had a controller. I don't know what this guy was doing. He was paying him $120,000 a year. And I'm like, what exactly? I'm like, he didn't do any accounting work. And meanwhile, Serge thought he was doing the accounting. And Serge had no way of knowing he wasn't. So we got a pile of garbage. And it's the same thing with Ramp. It's the same thing with Ramp. His accountants never gave him any advice. Never told him what he was doing. It was all cockamamie. No, he did have a bookkeeper. And what I told Chuck was fire him, because he doesn't know what the heck he was doing. He was doing bank recs, and there were outstanding checks that were like 5 or 6 years old. So you know what that means is they took a tax write-off for a check that never cleared. So again, we got garbage. And what we're doing is we're cleaning it up. So for 2022, we had to file the return with garbage information. And that's just but actually, what was garbage was the beginning balance. What we did, what you did, was at least you reconciled the accounts, right?
Yes, Joe. Yes, Joe.
So
Reconciled with the cash transactions. The only thing that not is the beginning balance, really, because they don't have accounting of
and
that.
there's nothing we can do about that.
Yeah,
Because
but
the tax
little by
return-
little.
the tax returns were filed. Now, if we wanted to fix it, we'd have to go back to 2021 and do all the accounting work over. But then we'd have to fix 2020. And you understand what I'm saying?
Yeah,
So
Joe.
tax accounting is not the same as financial accounting. Okay, the way the IRS would audit this is they would take all their bank statements and
Mm.
add up the deposits. Okay.
Yeah.
And see if if that matches the income.
Yeah,
And
income
then
and disbursements
then they would take the disbursements
for the
and
cost
say,
and
show me a
expenses.
canceled check. Now, that's why we reconcile. That's why we reconcile. Because just because they wrote a check doesn't mean if it didn't clear, the IRS would say, we don't care if you put it in your books. Where's the canceled check? And then they're going to want the bill. Now, luckily for them, they have all the receipts. They have tons and tons of receipts all over the place. They're not organized, but I said, okay, if there's an audit, and I've handled audits like this. And nothing bad happened. I mean, it was tough. But as long as the deposits match what's what we put as revenue, there's no problem. Now, I've had audits where the client lied to me because they came from somebody else did the return, and I would ask them, do all your deposits add up to what's on? Oh, yeah. And then the IRS would add it up, and they didn't. And I had one client that he got charged with a felony. He was a real estate agent. He lost his license, and he had to plead guilty to state income tax fraud. But that's because he lied to me. I didn't do the bank recs. I didn't do any account. I just got his tax return, and now I know better. That was when I first started. Now, if I get an audit, and we had them. We had one, I think, when Luz, do you remember Teresa Jung?
Yeah, the one you helped in.
Yeah, she got hit. Her accountant did, I don't know how they did her return, but it was, when I looked at it, I said, I'd be surprised if she didn't get audited. So what we did was we took all of her bank statements and we actually did accounting. And I was able to go to the IRS and say, listen, what they did was criminal. What the IRS did was criminal, because she had all the receipts, every one of them. And what the auditor said, oh, you didn't prove that this was for business. Now, what she had, it was a trucking company. So let's say she had $80,000 in insurance and $50,000 in gas. And he's saying, oh, you didn't prove that it's for business. So I went to the IRS and I said, listen, if you don't get rid of this, we're going to go to tax court. And then you're going to have to explain what your guy did. Because I could prove, because then I had the bank statements and I could show all the income. She lost money. She was bankrupt. And they hit her with a $50,000. They said you filed a frivolous return, so it's a $50,000 penalty. And then they said she owed them $200,000. And that Shirley Ann Felder sent her to us. She was her ex-sister-in-law. But that's why we do bank recs. It's the simplest, most fundamental accounting procedure. And these accountants, I don't know how that. We had a client, Estrella McKinney. I know Catherine loves her. Catherine had to. This was a big firm. They were qualified to do forensic accounting. And what that is they go to court and they prove, like when somebody has messed up records or there's a divorce, they'll find fraud. They didn't even do a bank rec for this woman. They didn't even do a bank rec. She owned, I think, 20 properties. They didn't even have a depreciation schedule that matched all the properties that she owned. Okay? And this is how we're going to scale this business. Because there's going to be a lot more people that are going to get in trouble. Because it might be 2 or 3 years from now, the IRS is going to be auditing a lot more people. It's going to be easy for them. It's going to be so easy. Because now what they do is they just ask people to fax in all of their bills. That's what Teresa Jung had to do. She faxed in all of her bills, and then COVID hit. And she thought, oh, they didn't get back to me, so I guess everything's okay. Until she got the bill in the mail. So what the IRS is going to be doing is they're going to be using AI. They're going to say, so when something triggered, because they can't audit everyone. When something on the return doesn't make sense, they'll audit it. They'll ask for all the receipts. And then what they're going to do is they're just going to send them a bill. They're going to say, oh, your receipts don't match your tax return. This is how much money you owe us. Mark my words. And that's why I started telling our clients how to keep their receipts. It used to be, nobody kept receipts. It wasn't that big a deal. Okay, now if they don't keep their receipts, they're going to be in big trouble. They're going to be in big trouble. And a lot of them think, oh, it's in my email. I'll just get it. No, you can't. It's impossible. It would be impossible. So I've been spending the last couple of years scaring people, because once it starts hitting, they're going to say, oh my God, I remember that guy Joe DiChiara telling me about this. We just got, so I know this woman, Sue, what the heck's her last name? I knew her from the same group that I met Larry in. She called me today because she remembered that I handled tax problems. She had the same accountant for 30 years. The guy retired. He sold the business to somebody new. They did what all the other accountants are doing now. They just took her information, plugged it into a tax return, never asked her one stinking question. And on October 16th, the day after it was due, they send her a return saying, oh, you owe $25,000. We're gonna help her with that. we're gonna help her. So what I'm saying is, over the last couple of years, I've just been planting seeds. I've just been planting seeds. All right.
Joe, I have another question. It's related to Dr. Galos. The partial year residency. First, my question is, if my observation is right, Joe, I notice when I calculate in Drake, automatically the federal and the state estate returns also generate automatically. And I noticed before George Galos is living in New Jersey, and then he has two W2 NY and California CA. So does it mean if the address of the client where he live and the employer's address, automatically the estates those estates will automatically generated the address of the client, the address of the employer?
So this is what happened. He gave us pay stubs.
Yeah.
He said that I asked him for them. I might have asked him for them. I don't remember. But the only reason why I would have asked him was to see how much he owed in federal taxes. Okay, I wasn't going to calculate his state. I never do that. I'm just looking at the federal. So he never got a W-2. So we never got it. So he's thinking, oh, he'll just use the pay stubs to do my tax return. You can't
Without
do it
the
like
double.
Yeah. So what happens is his employer sends in the W-2. It goes to California. So California says, oh, Dr. Gallos lives here. We're going to send him a bill. They don't care that he only lived there for a month. They're saying, oh, we're going to assume he lived here all year. So they took all of his income and they said, you owe us taxes. It doesn't even matter that the other W-2s say New York. Okay, if they're going to make a mistake, they're going to make it in their favor. So now he comes to what?
So meaning, Joe, if I'm in the US, I'm working in US, if my employer, so my estate tax return depends on the address of my employer. For example,
So that's another thing that's important, because, and actually that was another issue, because a couple of times we put in the address of the employer, not the address. So if the let's say our client lived in New York, but their company headquarters was in New Jersey, we were putting him as owing New Jersey taxes. That's not right. It goes by where they live. Actually, it goes by, and it should be indicated on the W-2. Okay. They could live in New York, but if they work in New Jersey, the W-2 on the bottom, it'll say state taxes, New Jersey. That's what you got to go by. Because we have no way of knowing. We have no way of knowing that.
We just copy, Joe, the info of the payer. So even if the client lives in New York, if the W-2 payer's address is New Jersey, we input.
No. I don't care. It doesn't go by the payer's address. It goes by what it says on the bottom of the W-2, where it says state income taxes.
There's a section below.
That's what you go.
Okay.
The bottom. Right.
Okay.
Because the employer is responsible for determining where they work. So sometimes you'll see it could be split.
Yeah.
Okay, we had a couple of those where, you know, they might have worked in New York for part of the year and then worked in New Jersey for the other part.
But by default, it should be the address of the taxpayer, right? Because
Right,
I noticed that there are W-2 that the state is not specified on the bottom portion.
There, it's empty.
that might be for a state like Texas that has no state income tax.
But there's a withholding tax, state withholding.
Oh, if there's state
There's a
withhold,
state withholding, but the state is not specified on the state section.
that's because they made a mistake when they did the W-2. In that case, you go by the client's address.
Okay.
There's no, you know,
Like Dr. Gallo's, Joe, the W-2, the employer is NY, but below the field number 15, there's NY and there's NJ. But it's 0.
because he probably worked in both states. That's the only way that happened.
Actually, it's Kathy's question because sometimes we do prior tax returns. So what if do we need to input the date, the address, the latest address, even though it's 2020, 2019, but the new
The
address
latest address, the latest.
latest, okay.
Yeah, that's a good question.
So, Joe,
Because if we put the old address, the IRS will get confused.
so it would mean that the taxpayer will be taxed based on the state where he lived, even if it's for prior year.
No, no. So let's say we're doing 2020 and they lived in New Jersey.
Mhm.
Okay. When we put the address, let's say that in 2020 they lived in New Jersey and then 2021 they moved to New York.
Yeah.
When we put the address, we got to put his New York address. But you'll see in Drake, they're going to ask you what state, and I forget how they ask you, but you got to override because Drake is going to assume that it's the state address that they lived in.
I think in screen 1, Joe, is that
the resident address?
yeah, the resident state in screen 1
Resident
because
state
there's
address.
Right.
Okay.
Let's open it up.
Okay, so we can put the complete address, but in the resident state field, we need to put the correct address on
The
that.
address.
Okay,
So let's open up the 1040.
we're learning a lot now, Joe, because we're doing things that we just realize it's a mistake.
No, I understand. We didn't spend a lot of time on state stuff. Why isn't this open?
You can try Bordolis, Joe.
Yeah, I had a good conversation with her today.
I need to review the recording.
I sent it to you. Okay, so let's see. So, and actually, she might be a good one. Okay, so this is the mailing address. Okay. Down here, you put the resident state.
Okay.
And that's going to go by whatever it says on the W-2 on the bottom.
Okay.
Okay. And then what we do, let me find somebody that was in New York City. Because this was another issue.
Yeah, the New York, especially the
So,
code, it's confusing.
yeah, and it's really hard for you to know this. you might actually have to look at a map of New York. But let me, okay, so Lisa Jones, I think, lived in New York. So in New York, so she actually lived in New York City. You see this?
What's
So a
Yonkers
lot-
though? Is that another? We don't usually choose the Yonkers, right?
No,
Always
you
and
don't have anybody that lives in Yonkers. So here you see 369 Manhattan, right? So New York City has 5 different boroughs. They call them boroughs. There's Manhattan, Queens, Brooklyn, Staten Island, and the Bronx. Okay. We definitely never talked about this. So what I did was when I got a return and this was checked, so I know who lives in the city. I just know. So I would just take this off. And sometimes the way, so let me show you how I figure it out. Because if you know how I review this, then you'll make less mistakes. So when I look at the return, I'm going here and I'm just looking at their income. So a couple of times I caught Schedule Cs. People that, you see this business income or loss, Schedule C. Sometimes that's because they got a 1099. But they shouldn't have, because they forgot to tell whoever was paying them that they were a corporation. So the way that we take care of that is, let's say the Schedule C income was 50,000. I'll put a note on other deductions, and I'll take a $50,000 deduction, and I'll tell the IRS, this income was reported on S Corp, federal ID. I'll give them the name and the federal ID number. Some industries like, so we have Matt Hughes. In that industry, they have to give the 1099 to the individual. It has to do with financial licensing. The thing is, by law, they can do business as a corporation. So we set Matt up as a corporation. He deposits all that money in the corporation. And when he gets to 1099, that's what we do. We put it, because if you don't report it, the IRS is going to send him a bill. So we report the income, but then we take an offsetting deduction. And that's totally legal. I've been doing that way for 40 years, never had a problem. All right, what else? Let me see. Oh, so I'm gonna eyeball the front of the 1040, then I'm gonna look at the Schedule 1. I'm gonna make sure that the income reported from the S Corp actually matches the S Corp. Because that's enough. And we didn't make any mistakes on that. but I still will check it. Then I'm gonna go down to the state. Right? And this is how I caught those returns that said that they were New York City when I knew that they weren't. So everything on the state flows through from the federal. So I don't have to worry about what's really reported on the state, except for this. This is where it shows the taxes. So she's got New York State tax. And then she's gonna have New York City tax. Now, for her, that's right, because she actually lives in the city. But if Bob Goldman, who I know where he lives on Long Island, he doesn't live in the city. If this said city, I'd go over here and just take this off. Okay, let me see, because I did have notes here. Negatives. Oh, yeah, well, we talked about the basis. Let me go back to the basis stuff. And then I only had one last thing. Take an S corp. So what'll happen is, let's say we have a client with a loss, and we have a lot of clients with losses. If the basis is less than the loss, what's going to happen is the K1 isn't going to show the whole loss. Let's say there's $100,000 loss and the basis is only 50,000. What's going to happen is the K1 is only going to show a $50,000 loss, and it's going to carry forward the rest of the 50, the rest of the 100. It'll carry forward 50,000. So where you fix that is, where the heck is it?
Joe, it's the net loss carry forward.
Yeah, but they shouldn't
NOLCO.
have any
Like
loss
NOLCO
carries.
in Philippines.
Let me see. Oh, AMT and basis. No, this isn't what I want to see. How come I don't see it? Distributions. Oh, that's not it. Okay. So shareholder loan is going to increase their basis, but why can't I find this now? It's gotta be here. Oh, here. Okay. So you see this basis worksheet? So if they have a loss, and usually, to be honest with you, I'll just fudge this. I'll just make it come out so that their basis is more than the loss. Okay, I could add something, so he didn't have a loss, but if they, and I'll tell you why, the way the program works, it's not gonna give them credit for any shareholder loans. It doesn't like automatically add it to their basis. See over here, you have to actually put the number in. So let's say Bob loaned his company $100,000. I gotta manually put that in. So I had to do that a bunch of times. But again, this is something that we never covered. We never covered any of this. The questions we covered. The negative accumulated adjustments we covered. But all this other stuff we never covered. So here's the last thing that I want you all to pay attention to. I know what I taught you was to get the green lights, right? We want to get, well, I don't know if some of the newbies knows what the green light means. Let me show you. So what Luz does before she sends it to me, okay, so this was already accepted, but before it got filed, there's either a red light here or a green button. Green means it's ready to be filed. That doesn't mean it's right. Okay, that doesn't mean that it's still accurate. It just means that it passes Drake's protocol to send it to the IRS. What we need to do is go into the messages. Now, sometimes the messages are just like, oh, so this message is, listen, we've already filed this return. Okay, but a lot of times there's other messages that we should look at. Like the balance sheet doesn't balance. Believe it or not, they'll still let us file a return if the balance sheet doesn't balance. They shouldn't, but they do. And then we have state messages. So this just gives us more information to help us file a better return. Okay. That's all I had, which is, to me, that's pretty impressive.
Jack, can I
That
add?
really, the only major mistakes were, and they weren't major, they were all things that we never covered.
Yung
Any other
question,
questions?
if ever the address is different in the articles of incorporation versus the IRS file, which
Gotta
should we
be
correct?
fixed.
It's gotta be
So,
fixed
yeah,
before we file,
because,
or is it okay
and
after?
we ran into some big problems because Elizabeth, we had 3 clients, Jesse Mogul and Sue Bonzel, that moved. And Elizabeth was supposed to change. So when they move, you got to change the address with the Secretary of State. And actually, they didn't just move, they moved to other states. So the articles of incorporation always have to match the tax return. And that means, so sometimes you got to go in there and file an amendment. And you got to change the address of the registered agent. Because if there's ever an issue, they're going to send it to whatever address they have on file for the registered agent. Okay, but that's a good question. You know, one thing that always amazed me, I said, why doesn't the IRS cross-reference with the secretaries of states? And I'll tell you why. Because people set up a corporation, they open a bank account, and they never file a tax return. I've had so many people come to me, and most of the time it's like somebody wants to be partners. And so I'll say, so my client will come to me and say, oh, I got this guy, my friend, he's opened a business. And I'd be like, okay, have him send me the tax returns. And I'd get the returns and they'd actually be zeros, or they never filed. But you see what's happened, the new law, now the banks have to tell the IRS who has business accounts. There are millions of people out there running businesses that just don't file returns. And they get away with it because they can open up a bank account. And the IRS could never cross-reference it. And I always said, there's something wrong with this. It was just some, and probably the truth was the Congress never gave them the money to set up the system. They never gave the IRS the money to link with the banks. And there was never a law that required the banks to give them that info. See, what should happen is if somebody opens up a corporation, it should go right to the IRS. Hey, these people have a corporation. They should be filing a return. Even though they file for a federal tax ID number. You know, I had a friend, she was brilliant. She worked for companies that got big government contracts. And what she did was she was a programmer. And they had what they called, there was a term for it. And what it was all these government agencies had old systems. And I'm talking about the military. The military had outdated computer systems. So her job was to go in there and update them. The IRS's computer systems are so antiquated. And I'm pretty sure I would put money on the fact that they got hacked. They got hacked during COVID. Because that's why so many of these crazy things, you know, we're getting returns rejected that shouldn't be rejected. We got, you know, with, who was it? ASAP. We got accepted, the IRS accepted the return, but they were never processed. So the IRS is saying that they never filed a return, which means that John Napolitano cannot get the $350,000 SBA loan that he qualified for because the IRS screwed it up. So if it's a computer and the return got electronically filed, How is that not processed? How is it? That doesn't make any sense at all. It just doesn't. And then, what was it? Last year, the IRS sent notices out to people saying that they owed money. And then the IRS had to apologize, saying, oh, those letters went out by mistake. How does that happen? Okay. That's why the IRS is getting $80 billion to fix their system. That's why they're hiring 80,000 people. And that's why I'm saying over the next 2 to 5 years, we're going to be swamped with new clients. We're going to be swamped. What I want to start doing, part of this jumpstart group that we're going to have, is I'm going to start teaching about tax problem resolutions. What do you do when you get one of those collection notices? What do you do when your client owes money? What do you do and lose actually one of those CPE credits that I signed up for? You're going to learn about tax problem resolutions. And I'm going to get the credit for it.
We want that. I'm sure Kathy and Miss Agnes also are interested.
Well, you can. Well, you're going to get actually a PDF file. So yeah, you could share it with everyone. I picked a couple of courses I thought would be good for you. And you just have to have them done by tomorrow.
I
Any
can finish
questions?
before I clock out. Joke.
I'm joking. It doesn't have to be done till the end of the year.
Joe, just a follow-up. This is related to the question of Mariko. We have a client, a foreign client, that's what's the name, Mariko?
Saunders
Sanders?
Ventures.
Saunders
Ventures.
Venture. It was
Johan
incorporated in,
Potgieter.
yeah, it was incorporated in Delaware, but the principal address is in New York. So we will just put Delaware in the resident state. Is that how it works?
I told them that's a problem. They don't actually have it. They have, I think, like a virtual office
in New York.
Yeah. And I told them that because if you're doing business, if you have an office in New York, you're supposed to be registered there.
Yeah, I'm also checking the articles of incorporation in New York, but there's nothing.
No, we're going to use the Delaware address. I'm glad you brought that up.
So in his business return, instead of will it not be a problem, Joe? Because the EIN address is in New York, based on the SS4.
Yeah, no, that's not. See, that's federal.
Yeah, federal.
If we file a New York return, what's going to happen is New York's going to come back and say, hey, you're not registered here.
So we will not file the New York state return.
No, you're going to use the Delaware address.
Okay.
And then we'll have to remind them to get rid of that New York office.
Okay, John.
Okay, noted.
Use the articles of where they are registered.
I had a client.
Incorporated.
I had a client. He was from Poland. Okay, the guy was a jerk. And what he did was he went through Gusto. Gusto actually helps people incorporate. And they incorporated in Delaware. Well, I got him because I met his employee at a networking event in New York City. So they had an office in New York City. They had an employee. So I told this guy what I just told you. I said, listen, you have Nexus. Nexus is when you have a physical presence. And having an office and an employee is definitely nexus. And I wound up telling the guy to go fly a kite. I said, look, he was arguing with me. I'm like, he's like, why would a big company like Gusto not tell us this? I said, because they don't know. They don't know. And it was the same thing with that guy from, what was it, Biosphere. He insisted that he had something called
Biostar, Joe.
Biostar.
Biostar.
Yeah.
Yeah.
He said they had an unincorporated business filing as a corporation. No, it was an unincorporated association filing, and I told him, I said, that doesn't exist. So what he had, so you can have an unincorporated association if you want to have like a kid's sports team, because you need to have then you can get a tax ID number, you can open up a bank account, but they don't file tax returns. So he insisted, oh, no, this, and then later on, he came back to me and said, oh, I talked to some people and you were right. But the guy was just so hard-headed, you know, we told him to go fly a kite too. So I told Janine, just so you all know, I'm not telling any clients to go fly a kite anymore. We're gonna have a meeting about it before we let anybody go. All right. All right, I think this was good.
Joe, I have last question.
Okay.
For example, if the client change address, once we already corrected it in their tax return, it will automatically, the IRS will automatically update their record. We don't need to file Form 8822.
Nah, that form is obsolete. So this is what happens when somebody when they move, they go to the post office and they get a change of address. That automatically goes to the IRS. So then our client will get a letter saying, oh, we updated your address. You know how many times I got one of those? You know how many times I've moved, Liz, in the last 3 years.
Yeah.
So I'm like, why do they even have that stupid form? Why do they have a question on, they have a box on the return that says new address? I don't get it. I don't get it. Some of the things they do just make no sense.
Joe, can I add more?
Yeah.
Another question. We have a client, Michael Robbins, if I'm not mistaken. He
Yeah.
moved out, and then we need to also register his business on his new address.
DC. Yeah.
Yeah. So we have a clients like Bordulis. She moved out in Texas this year. So do we need to update the registration of her business?
Yeah. Yeah. Actually, so where was she before?
If I'm not mistaken, in California, I'll double check. But I know she moved out this year in 2023.
Yeah, that's a good point. That's a good point. We need to end the California Corp and incorporate her in Texas.
Okay. So we need to list down all the clients that move out.
Yeah.
Thank you.
And then we
And
get
Joe,
to
one last
how many last questions are you gonna have, Liz?
No, I just remember because it was recommended by Cathy starting next tax season. I think it's okay, but it depends upon you, Joe, if you'll approve it. She recommended that every time we prepare the tax return, also prepare the power of attorney at the same time. So we have
Oh, no, yeah. I just
yeah.
said that I had a client meeting and only Allie Perkins showed up. And we're
Yeah,
gonna have.
and
another
two
client.
new clients, Kathy and Myrna.
Yeah, yeah. But I told her, I said, I think we're gonna, so I don't know if we need, so here's the other thing. Yeah, it might just be easy to just do the power of attorney. But there's that box on the return that says, third party, they can, they can elect a third party. Maybe we do both. But what I saw on Drake, there's and I'm pretty sure this is oh, here it is. Here, let
Can
me
you
show
share
you.
your schedule
Yeah,
so we can visualize?
e-sign. You see this?
Yeah, I think it will make Kathy's work easier
All
once.
of our, yeah, all of us, because then we don't have to wait for them to print the thing, you know. So
But
this,
it has a charge, Joe. Maybe you can just charge it to the client.
yeah, how much?
We'll see. Because right now you have 0 allowance for the e-signature purchase.
E-sign. Yeah, I mean, if we gotta pay,
You just charge it to the client because
yeah. E-sign information. All right, I'm not gonna go through this now. I think we have the client meeting starting.
It says e-sign events 0.99 per event. Bulk e-sign events 0.89 per event. I don't know if this is accurate, Joe.
What's that?
Bard said Drake e-sign online events $0.99 per event, and if it is a bulk e-sign events 0.89 per event.
what?
Zero
I
point
mean,
eight.
yeah,
I
less
think
than
that's
a
the
dollar
charge
for the charge
per
for
signature.
Oh, good, then
e-signature.
we'll charge our clients $10.
Sure.
Do you have a
Yeah, because
question on it?
Yeah, related to the question of Kat about monastery. He's also incorporated in Delaware, but the state is in California. So,
Wait, who is that?
monastery, like
The client of
Sanders
Melon.
yeah, our new client.
the one you're
Which-
asking, the 3-year
The one
tax
you're
credit.
follow-upping.
Yeah,
Yeah, the
Oh, the
foreign
100 thing?
yeah, the monastery.
yeah, related
Oh,
to the address.
That's gotta be fixed then.
So the state address will follow California, not the
Why do they have
Delaware.
California?
Their address is California.
So sometimes they'll use an address because they know somebody there but it's gonna cause a problem.
So better yet
Especially,
use Delaware.
listen, California is the worst state. They go after people like right away. They go after people right away. So all these clients with the wrong addresses, we got to tell them that they got to be fixed. And then we'll tell
So
them how
we'll
much
also
to
follow
charge them.
Delaware's state address.
They can't be registered in one state and have an address in another state. People have been getting away with it, but the states are tired of it. So think about this. If they are actually doing business in California, California wants the taxes. They want the taxes. So it's just a matter of time. You see, all of these, and the issue is they haven't had a way to police it. They have, but with technology now, it's become easier. It's become a lot easier. And not only that, all the states and the federal government, they're talking to each other. Not only that, all the countries are talking to each other. All the countries, they all got, there's like 140 countries now that got together because in the United States, big companies like Apple Computer, Google, what they do is they set up subsidiaries in another country with lower taxes, and they say, oh, all the money we're making is from that country. So yeah, there's a lot of things going on. A lot. All right, no more questions. I'm starting to get a sore throat now. All right, ladies, thank you. Have a good night.
Thank you, Joe. Thank you.
You're welcome.
You
You're
know,
welcome.
Joe.
Bye-bye.
thank